Gold has passed through $2,500 per ounce. Is it overpriced? Not according to one longtime metal strategist who says, don't focus on gold's price, focus on why you need gold in your portfolio. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe and we'll keep you in the know. Ed Coyne of Sprott Asset Managers recently cited what he thinks is the most significant error that investors can make when considering gold. I think the biggest mistake a lot of investors can make is trying to time when they buy and when they sell gold versus looking at gold as a percent of their portfolio. What he means is that gold can benefit a portfolio at any given time without regard to the metal's price. Coyne sees the continued decline of the purchasing power of the dollar as the most reliable catalyst of gold's safe haven property. This relationship between the dollar and gold is why Coyne dismisses the idea that the metal could be subject to overvaluation. When you look at the long-term performance pattern of gold over time, the purchasing power of the dollar continues to go down and gold continues to go up. So I don't really think there's a price high in any cycle. Coyne illustrated his point this way. When I started with Sprott close to 9 years ago, gold was considered expensive at $1,200 per ounce. Then it was considered expensive at $1,600 per ounce. Then it broke through $2,000 per ounce during the global health crisis, and people were like, well, we missed it. The trades already happened. And now it's over $2,500 per ounce. The gold buying rationale of renowned hedge fund manager Porter Collins, who recently called gold his, quote, highest conviction trade, is very similar. Collins says he sees himself potentially holding gold for at least another decade because of the same concerns about the dollar's purchasing power cited by Coyne. We have this dollar debasement thesis. If you think about the world we live in, we hate the deficits. It's $1 trillion of debt we're adding every 100 days. It's too much. He also said this, I just don't think Americans have enough gold in their portfolios. Ed Coyne would agree, and he seemed to be speaking about Collins and others like him when he said, some of the most successful, storied investors out there have used gold over multiple market cycles. They really focus on what percent of the portfolio gold represents and why they're allocating to it, not what the return is or what the dollar value of gold is. Coyne says gold's structural position is what allows the metal to enhance returns over those multiple market cycles. If you look at gold year to date, it's outperforming. If you look at it on a 3-year basis, it's outperforming. If you look at it since the introduction of quantitative easing and financial engineering going back to early 2000, after the tech bubble burst, gold's actually outperforming. In fact, since the beginning of the millennium and over numerous market cycles, gold has been one of the best performing assets, rising more than 800% up to this point. Where gold goes, nobody knows. But that's not the focus. Coyne suggests that might be the most rewarding mindset for a gold investor. Widen your lens, he tells investors, recommending they focus not on price or price potential, but on what he says is the real utility of gold in the context of a portfolio hedge, its capacity as a store of value. The mindset he feels is one that belongs to those who recognize gold's suitability as a core portfolio holding, one that he calls an evergreen allocation, meaning good to hold always. That's why I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.